comfort those who are in any affliction with a comfort those who are in any affliction with the comfort with which we ourselves are comforted by God. Psalm chapter 23, verse 4. Even though I walk through the valley of the shadow of death, I will fear no evil, for you are with me. Your rod and your staff, they comfort me. Matthew chapter 11, verses 28 to 30. Come to me, all who labor and are heavy laden, and I will give you rest. Take my yoke upon you, and learn from me, for I am gentle and lowly in heart, and you will find rest for your souls. For my yoke is easy, and my burden is light. Psalm chapter 119, verse 76. Let your steadfast love comfort me, according to your promise to your servant.
Yo, good morning, everybody. Hopefully y'all had a good weekend so far. Let's dive into some stuff today. Good morning, Fritz, Zach, Tony. Good morning, good morning, good morning. So yeah, we'll see what we can get into today. So next week is CPI. So that should be interesting. Good morning, Z. Appreciate you guys for hopping on. I'm kind of sick this week. Hasn't been very nice, but still had a good week. Took Monday off. But yeah, hopefully this goes away. I can still feel it in my throat. It's not the greatest thing, but we got shit to do, right? So CPI, those of you that have been with me for a while or have studied ICT's concepts, CPI is generally a one-stage event. So when it rips, generally it keeps ripping. You know, there's sometimes where it'll rip and then come back and then continue with what it initially started to do. And that's a little bit different than NFP and FOMC. Those are two-stage events. So the first move is generally fake. So if it runs higher at like 5:30 a.m. Pacific Standard Time, and then there's a news event maybe at 7, or even if there's no news, after the open, that initial move a lot of times turns into a fake move, which we just seen that with NFP, right, that just passed. So you're going to want to go look at that and study it, because it definitely did happen. But yeah, so this week we also have no news on Monday or Tuesday. So that's leading up to CPI. One thing you want to consider as well is Congress. Is it Congress or the Senate? I'm not sure if it's both, but our government is basically on a vacation. It must be nice. So it's going to be a little bit of a problem, I think. Generally, when they go on recess, there's not a lot of big announcements that take place. Obviously, we still have CPI and some other stuff coming out, but a lot of the big things that generally come out, some of that stuff's going to be on the sideline. So it's just something to be cautious about. Doesn't mean that it's automatically going to not have any opportunity or whatever, but it's just something you got to be aware of, right? So that's happening. And like I said, there's CPI. So when we look at this news schedule, the very first thing you got to do is think power 3, because Sunday, Monday is generally accumulation. We don't have news on Tuesday, so maybe the accumulation and manipulation will bleed into Tuesday. It just really depends, right? We're going to have to observe and see what it's going to want to do. And then going into Wednesday, we got CPI, and then Thursday and Friday, depending on how CPI delivers, if CPI just rips to a logical level, which we're going to lay out here pretty soon, in a little bit, right? We got a little bit of a process to go through, but depending on what happens, how aggressive it is, what PD arrays and liquidity pools are available, if it hits one of those significant liquidity pools or PD arrays, Thursday and Friday could generally present us with the opposite end of the weekly range, or TGIF, right? So just something that you got to keep in mind every time you look at this news calendar. The first thing that I think of is Power 3. How can these events fit inside the different phases of a Power 3 delivery? And I've learned over the years, almost a decade now, 7 years, my anniversary for being a trader just passed on the 4th. But through these years, since I've been studying ICT, it's just very important to understand that Power 3 can be observed through these news events. And if there's no news on Monday and Tuesday, I mean, that's pretty nice, because then, depending on what the news does, we could outline this pretty simply many times in terms of Power 3 accumulation manipulation. And then the distribution is kind of laid out, right? So we'll see if that can, like that template, that perspective can unfold. So keep that in your notes every single week. I talk about this every week. I say the same stuff every week. And for whatever reason, it seems to follow what we talk about, right? So there must be something to it. Good morning, Jen. Appreciate you for hopping on. Jen was live with me all week. Let me see. Do I have any other private students? They'll probably hop on later. But yeah, so if you haven't put that in your notes, you need to put it in your notes. I repeat this constantly. When you hear me say something over and over and over and over again, clearly it's important. So you want to be a good student and note these things, because Power 3 and market maker models, for those of you that don't know, that's the core of what I do. Everything that I do can be shoved into those two frameworks. It's very simple, right? I don't have 1,000 different things that I'm doing. There is a reasonable size process that we go through every week, every day. But at the core of it, right, to keep it simple, those two frameworks is what I'm looking at, right? If I'm looking at any time frame, a 15-minute candle, a 1-hour candle, daily, weekly, yearly, quarterly, I don't care what it is, I'm thinking Power 3, because there's an open, high, low, and close. And Power 3 also works in conjunction many times with the market maker model concept. So if you haven't done investigating on this, you really should, because I think that discovery in itself is going to be very shocking to you, right? And you want to study each one individually, obviously. That's true with every concept that you learn in ICT's world, because they're all different puzzle pieces. And I thought of this analogy the other day. How people be talking about the market being a puzzle, right? Well, that is true, right? But when you're trading ICT concepts, you got to think of every single thing that is taught as a puzzle piece, right? You're not going to need every puzzle piece, so it makes it a little bit unique. But you do need a certain amount of puzzle pieces. And I lay out a list of concepts that you want to have processes for in my private group. I think I shared it in the free group as well. And when you get those pieces together and you understand each component, and you have a process for each of the 10 different categories that I talk about, you can rest assured that you have enough to do pretty spectacular things. But you don't need every concept. But every concept you're learning is a puzzle piece to your puzzle, which is your journey, right? And then, of course, the understanding of the market. So when you think about things in this way, it makes an emphasis on studying each concept more important, right? Individually. You don't go into the chart and try to find everything you've ever been exposed to when it comes to ICT, right? You want to have someone that can guide you into the things that are truly important, obviously, because there's so much. Obviously, you don't have to. You could do it on your own. But with all the resources that you have, why would you do that? It's going to take you longer. It makes it harder. It's already hard enough, right? So if there's someone that shares their opinion that actually can prove that they know what's going on, it's good to spend time with those people. And if that person is me for you guys, then, so be it. And I'm appreciative of that. And I try to give you as much value as possible. But so yeah, you want to look at your journey like this. But coming back to the power of 3 idea, again, I mention this all the time. It's constantly repetitive. It happens every week. It doesn't always look exactly the same, but every single weekly analysis, when you look at it from the end of the week, you could see that there's a method to this. And generally it circles back to power 3 and market maker models. In my private group, even on the live calls I do on Tuesday, or when I have the little marathon, which I think I got to do that this week, huh? It's the 9th. Yeah. So I guess, is it? Wait. Yeah, 1 week's already passed in August. So yeah, we'll do the marathon this week, actually. I was thinking it was going to be a week from now, but so be prepared for that. But yeah, you want to look at things from the lens of power 3, okay? CPI's coming, so we got to be cautious. Monday, Tuesday. It should be low probability. Whenever there's no news, you guys want to consider the fact that it's low probability. Probably going to have somewhat of an issue, but we'll see. It's not every time that there's no news prices is causing issues, but it's definitely something that we're going to keep tabs on, lower our risk. CPI is going to be one-sided. I mean, there's a lot of stuff happening in the economy, so it's going to be a bit hectic. But for those that are new, almost forgot to show this. This is what we do in these calls. So if you haven't screenshotted this, it's not only a rubric for what we do, but it's also an outline for you. And notice the concepts that I have mentioned in here. Okay, it's not every ICT concept. Okay, I don't need every concept to do a weekly analysis that's effective, or even a daily analysis that's effective. The more weapons and tools that you have, the more pieces to the puzzle that you have, obviously it could be beneficial, but then again, to an untrained mind, it becomes an issue because you're going to just throw the kitchen sink at everything and it becomes a problem. Any earnings coming up? I'm not sure how to spot big names. Okay, so you can actually go use this. This is what I use to identify earnings. Let me see. Fundamental calendar. Earnings. So this will tell you what's happening, like what earnings are coming out. And you look for your big names, like the top, 10 or 20 big names in the S&P and the NASDAQ and the Dow. So you just look for the big names. If you don't know the names, you could just go in here and do some investigation on the different companies. But this site is called Trading Terminal. Whoa. I don't know why. Make that smaller real quick. Okay. So tradingterminal.com. I think it's the best. It's a free resource. So if you do want to observe, why is the thing so stretched out? Jeez. It keeps stretching to the screen. I don't know why it's doing that. It's so weird. But yeah, it's tradingterminal.com. That's how you identify the earnings. Okay. So yeah, you're going to want to start the week slow, very soft. We're not going to be doing anything too aggressive. No worries, Fritz. Don't worry. Definitely, if it was a problem, I would have waited. I know a lot of people, they ask me how I look at the earnings because I trade stocks too, long term. Well, I guess it's not trading stocks. I long-term invest. So I get questions about that all the time. So I'm happy to answer any of those questions, or even look at stocks later on if we have time. But yeah, so Power 3, CPIs on Wednesday, Monday, Tuesday, there's no news. We'll expect accumulation and manipulation. And I believe that the main moves are going to come later on. So the weekly profile may be a Wednesday higher low of the week, high or low of the week. We'll see what happens when we do the analysis later, what we're expecting. But yeah, and then Thursday and Friday, depending on what happens with CPI, obviously we're going to have to go off of what's left. So yeah, one thing I do want to pull up as well before we get into the analysis is my liquidity mapping principles. If I could go find it. For those of you that are new, these are very important things. Okay, I don't know what this white outline is. It's weird. I don't know why it's got a white outline. Whatever. So yeah, if we go to my liquidity mapping principles here, I have high time frame liquidity references and lower time frame liquidity references. I have a little bit of a description in here, so if you haven't screenshotted this and you suck at identifying liquidity, or you've had a struggle trying to identify what highs are important, what lows are important, this is one very easy way to look at things. You also, what I don't have here, I don't have the last 3 days mentioned, so the last 3 days goes on this as well. I definitely forgot to update this. I talked about it was it last week? Maybe the week before that. Got so many things going on. But you can also add the last 3 days, the last 3 weeks, depending on what perspective you're trying to identify for liquidity. The 20, 40, 60-day look back, cast forward. I talked about that last week, how to utilize that. So that's significant. Hopefully you guys have been studying that as well. Again, in a nutshell, you just take the current month, cast it back 20 candles. So 20 days, right? You're not including the weekends. So 20 candles on the daily chart. That's your 20-day structure. 40 days. So you look at the last 40 and then the last 60. And then that gives you really, really likely liquidity pools. Long term is obviously 60 days. Intermediate term is 40 days. Short term is 20 days. And like I said, an even more short-term objective, excuse me, is the last 3 days. Okay? If ICT says himself that if you only go off of the last 3 days of liquidity, you will always have liquidity pools to target and something to frame your trades on. And I would have to agree with that. And I'm sure if you do back testing on things, on this concept, you'll also see that that's the case too. Okay? But yeah, so take a screenshot of this. I'm not going to go over it entirely, but these are levels that I like to identify on a weekly, daily session basis. And it helps me stay calibrated with what liquidity is more likely. Well, not more likely, but what is likely for counterparty, right? To be used as counterparty and then also target. So definitely consider looking at that and studying it, okay? And I got some other resources too in the free group and obviously more in the private group as well. So yeah, let's go check those out. But hopefully all this stuff makes sense. You guys have any questions? Chris, I see others attempting to use news events for one-day past opportunities. Yeah, well, those people are fucking idiots. I'm just going to put that out here. If that's what they're doing, I wouldn't listen to those people at all. They're idiots. It's completely stupid. It's like one of the dumbest things. I hear a lot of people doing that for whatever reason recently. And I'm like, who are these people? I mean, they're gambling. If you trade on news, yeah, exactly, Fritzy. If you trade only on news events to get part of something that you can't expect, that's a gamble. We can't anticipate what they're going to do immediately at the open, like of a news event, especially not CPI. Obviously, there's ways to get context and determine what the overall draw on liquidity is, but you're going to have like a 150-point stop, because what if it comes out and there's a huge wick that happens and they're over leveraging because they want to be part of that big move? It's like a rookie thing that people do a lot of times. And if there's anyone with a big following that's talking about that, I mean, clearly they have literally no clue what they're talking about, or they just have no experience. And you can't knock them for having no experience, but you can knock the people that follow them knowing that they have literally no experience based on the actions they take. And that right there is, in the purest form, gambling. Because even ICT himself says, you do not want to take a trade right at the news events, especially CPI, NFP, FOMC, rate announcements, because you just don't know what they're going to do. The news events are used as excuses for them to manipulate price. Everything is already programmed before it happens. Sometimes it's already priced in. So when the news events come out, we're getting to the party late, essentially. And we're at the whim of whatever they're going to do with the manipulation. Because again, the news events are used for manipulation. And over time, obviously, you could see that this is the case. Let me see. Ashley said you wait for liquidity sweep, ICT. Yeah, exactly. You don't really want to trade right at it, but that's true. You wait for liquidity to be taken after the news events, generally 30 to 45 minutes after, like NFP, right? That's a rule that he teaches. If you must trade NFP, which I don't know why you would must or have to trade it, especially with no experience. But if you do eventually, and you get comfortable with yourself as a trader, and you're okay with that risk, you know that you could be wrong, more often on those days than opposed to others. Then you could just wait for some of the things like Ashley just said. Wait for a specific liquidity pool to be swept against your higher time frame narrative, 30 to 45 minutes after, and then see if you can't find one of your models to unfold, targeting, in my opinion, one of the liquidity pools that are on my liquidity mapping list. If they're available, right? Use one for counterparty after the news takes place, like the first thing it reaches for. And then if it rejects those and is in line with your higher time frame narrative, which again, we do that here, we paint that here before the week starts, then you can trade within that narrative that you've already painted and already assumed. But there should be zero gambling at the news events. And if you see anyone doing that, I'd be careful not to pick up horrible habits and perspectives that are going to turn you into a gambler, because that's not what we do here. That's not what you should do either at all. But, it's the internet, and it looks crazy when you're able to get something correct on a news event, but that's not sustainable. And the next time, you may get unlucky. And if you get caught with the news event, say you have a 30, 40-point stop, even a 100-point stop, and when the news comes out, one 1-second candle flies 1,000 points or 300 points or some huge manipulation that you weren't prepared for, and you're in the trade, the slippage on that, you're not going to get out with the intended objective, especially if you have a real account. They are going to position you when they feel the need to do so, right? So you could sit through your whole entire account going into the negative, and if you're over leveraged and you're trading a live account, you will owe the broker money. You'll go into debt and your account will be closed, and you'll wish that you didn't do it, right? Because that's the risk. That's the inherent risk in the marketplace. And it's not only news events that propose this risk. If you're in a trade and say a bomb drops and all of a sudden the markets start to go crazy and your stop was at 30 to 40 points, but the move against you goes 100 or 200 points in a second, you're going to get out most likely more towards the low of the manipulation that just happened. It's not every time, but you're not safe in those environments. And the markets are already risky enough. So for people to be on the internet, it's obviously for entertainment, but for them to be on the internet with any type of following, promoting this idea because it gets clicks, it's like the blind leading the blind. It's like the butcher who's also going to be slaughtered leading his followers to the slaughterhouse, right? So just keep that in mind when it comes to these things. I appreciate the question because it's definitely an important topic. And for whatever reason, I've seen a lot of people getting attention doing this stuff. There's a couple that have already been doing that for a long time, but I don't know what's going on. Like, people are trying to gamble these days because it's exciting, I guess. But if you want this to be a business, if you want this to be sustainable, something that you can reliably quit a job with, it's not going to come from you trying to pass evals or taking trades, gambling, hoping that it's going to go in your direction with a 500-point candle from a news event. It's sustained base hits over time that make it so you can quit your job, that make it so you can be profitable. And of course, every so often you'll be able to catch those runners. But again, that's going to come from understanding this process that we do here, or any other process that's effective in identifying narrative on the higher time frame and trading with that higher time frame narrative, because that's the big wave, right? Those are the big players pushing price or being participants with institutional sponsorship. Okay, but again, that takes time, and I kind of lay that process out for you on a silver platter here, and you have the benefit of also seeing the stuff operate properly and work. So that's why it's going to be very important for you guys to take notes and stuff like that. But yeah, so hopefully that answers that, or that opinion's helpful to you, MIC. Good morning, Fancy. Appreciate you hopping on. But yeah, if you guys have any other questions, of course, you can always let me know. Maddie, welcome, bro. Didn't see you earlier. But yeah, so those are my thoughts on some things, the news, that question. So let's move on to the bonds and yields, shall we? So as you guys know, the bonds and yields are very significant. I start with this every single week. The yields have a positive correlation generally to the dollar. Obviously, there's a Kraken correlation, so something on the back end that we're not privy to is taking place, causing this to have a Kraken correlation. So that puts you in a higher risk environment, which helps me personally calibrate my risk profile. If the bonds and yields and the dollar are completely out of whack, that's your first sign of a more risky environment to trade in. Okay, so some people argue with that, but I don't see what they're doing every week, being as consistent as this. But that's the first rule of high probability, right? It's market symmetry. And if you don't have market symmetry and you're going to trade, you got to keep that in mind and lower your risk, because at any moment they could flip the switch and all of a sudden everything just goes right back in line with what the risk on, risk off market symmetry profiles are supposed to look like, or relationships should look like. Okay. So we do see that this thing is running higher. If we go to the monthly chart, let's actually go to the quarterly chart, get a macro perspective. We do see that the dollar is hitting a breaker and it's starting to displace. We've actually so we have a quarterly change in state of delivery here. So we're definitely going to keep tabs on that. Let me actually take this to the dollar. So that right there is the quarterly change in state. We talked about that last week. Pretty much the narrative was correct, but just didn't run up. But we'll get to the dollar in a second. So yeah, we're looking at the quarterly perspective in here. We have this large wick in here. It's quarterly, yeah, quarterly. Got that large wick. Actually remove some of these things. Do got trendline liquidity. I would really like to see if this thing is going to keep going higher, that the dollar starts to bottom out a little bit. We are trading down into this wick here, but again, that's an order block inside of a breaker, and we have displacement. We also have a rejection block that's resting right here. So that, in my opinion, is also something we got to keep tabs on. Obviously, the quarterly perspective takes 3 months to print a candle. So it's not something that we're going to be basing day trades on, but this is definitely something that we look for long-term bias and narrative, looking at the quarterly perspective. Because if we don't, we're not affording us the ability to catch larger, higher time frame swings with clarity, right? If you can identify what the quarterly power 3 is, imagine what you can do. You can have a 3-month time horizon for a bias or a narrative, right? Bias obviously fluctuates here and there because of consolidation and retracement. But if you can be on the right side of the market quarterly, you can rest assured that your bias and narrative, right? Narrative being the big picture, bias being day-to-day targeting and whatnot. You could be on the right side more than you're not. And you could know when things are counter trend trading. And what does that help you with? Lowering your risk, managing your risk properly, because every moment in the market should not be traded the same. You shouldn't have 1% and then always, no matter what the condition is, trade 1%, right? If it's choppy, sloppy, nasty price delivery, cracks and correlations are all over the place, and things are just looking a bit hectic, you want to be able to have times where you accept the fact that, okay, I'm going to lower my risk a little bit. I'm going to manage risk and preserve capital as the capital manager that I am as a trader. Because you're not just taking trades as a day trader or a swing trader. You are a capital manager, right? A money manager. And the first rule of being a money manager is capital preservation and not allowing big drawdowns. You can lose, right? Notice I didn't say not losing. You're going to lose. But how you lose and how you react to that and what you do after those losses is what's most important. And again, just having some perspective like this that's so macro is very good long term, because you could then justify lower time frame delivery with a higher time frame context that is highly aggressive, okay, and sustains for multiple months, sometimes even multiple quarters. But that's how we're able to be correct more often than not in such a long time horizon. Basically, the last 2.5 years that I've been public on YouTube, and 5+ years, well, not 5+, but 5 years privately, is because we have these types of perspectives, right? And I know that a lot of times if it goes against what my initial bias is for a week or for a day, I could still fall back on the fact that, okay, well, we're still not done structurally on the larger perspective. So until something deeply changes, I'm going to keep hammering my bias, hammering my narrative, right? And then anything that goes against it, I'm going to lower my risk, So that's the ability that you're afforded when you have a perspective like this. And again, because we're such a higher time frame macro focused trader when it comes to narrative, we're able to be correct more often than not. And if we're incorrect, it doesn't shake our ability to see what price is doing. We just simply wait and still keep the context solidified from these higher time frames. And then we just keep pushing forward with the same bias until something's proven wrong. And part of that has to do with 3 PD arrays being violated, right? So yeah, I actually don't like how busy that looks. Let's make it a little bit cleaner. So this here is, why is it not letting me type? That's weird. Oh. So yeah, it's our quarterly wick. Why am I using this one and not these, right? This is another question that I get a lot. And ICT gets it a lot too. There's all these wicks and every wick can be graded, but why am I picking this one? Let me know in the chat why you think I would pick this one to pay the most attention to. I find that this interactive perspective gets a lot of good feedback. So I think I'm going to try to be that way a little bit more. But, it also depends on your guys' participation, right? If not, I'll just fly through it. Let me see. Fritz said it's the parent wick. Exactly. It encapsulates all these other wicks. Can you still utilize these? Of course, right? You could still measure those out, go to the daily chart, go to the 1-hour chart, and that stuff will still be significant. Okay. But this is the parent wick. And if this was, instead of a 3-month chart, if this was a daily chart, it'd still be the same thing. Even if it was a 5-minute chart, it'd still be the same thing, right? It's all the same. But the simple fact that we're on the quarterly perspective, obviously we're gonna have to stick to that and realize that this is long term. So when price retraces down, all of this should be balanced. So it should stay in that upper 25 to 50% of that wick. These levels, like the midpoints right here, that's the second largest, still would be significant, but notice how it's right at the center of that big one anyway. So it's got like a convergence. So when price opens up on the next quarter, we'll see what happens. We'll kind of do more of a deep analysis on that later on, but these are levels nonetheless that I want you guys to keep in mind. We do have also, when we shrink it down a little bit, we have more of a wick in here. I think that encapsulates it enough. So we're gonna take that off. I am gonna measure this or map this out. And again, the dollar and the yields should have a positive correlation, but they don't. So it's a higher risk environment. So what is our risk going to be? It's going to be lower risk. Instead of, 2.5%, 2%, or for anyone else like 1%, it's going to be dropped. We're going to cut it in half or at least by 25% less until things get back in line with correlation, because that's when you can start to see very low resistance, high probability setups that are just easy, taking the fruit off the vine. You know what I mean? And a lot of times you got to wait for those scenarios. But yeah, so this wick, price is coming back down into it. The reason that we have multiple that we generally look at, like the 30-year, 10-year, 5-year, we definitely want to observe SMT. If you guys remember, I talked about this maybe 2 or 3 weeks ago. Talked about how this was going to continue to rally. Well, not even 2 or 3 weeks ago. We talked about it from down here being a market maker buy model, and looks like we were absolutely correct yet again. Longer term, just kind of proving the point of why this higher time frame analysis is very, very critical. But now price is trading down into this. Let me actually clean that up too. This price is trading down into this wick, which had displacement. So we shouldn't see the upper 25 to 50% get traded through on a closing basis if it is going to try to get up here. But we have hit significant levels right here, being the opposing PD array to this uptrend in the form of a wick. Okay. So you notice how we're respecting that lower 25%. There's also a daily bearish order block there, which is interesting. Let's go double check that real quick. Yeah. 2-day. Yeah, it's a 2-day bearish order block. But again, we don't even really need that. We could just stick to the wick. It's in confluence with each other. So I do still believe this is a market maker buy model. I think that it'll keep going higher until proven otherwise. If this thing breaks down through this low, that'll create a bearish breaker. And then we'd have to study how it reacts to that. And if it reacts to it nicely going lower, we would have equal lows to target. And then we would get away from seeing this go higher a little bit. That would justify a deeper run from the breaker on the dollar, the quarterly breaker, the monthly breaker. Okay. It's kind of got time frame confluence with that. So we are going to keep that up there for liquidity purposes. Just calibration, essentially. So we have that liquidity, but then we also have this liquidity down here. So it is somewhat coming back into the middle of the range. So technically dollar is still somewhat consolidating. We did get this retracement. It has reacted from this breaker. I like equal highs up there. So we'll see what happens, right? We got sell side, buy side. Whoops. I should pull this over there. So we got sell side, buy side in the dollar, and we got nothing but buy side delivery here in the yields. So again, it's going to require a reasonable displacement lower. We have sell side, buy side. That's a market maker buy model I talked about. Price is now reaching up into these levels again. So these are still my targets. If price is going to keep going up, once it breaks above this high, then that'll be another change in state. We'll know that it's ready to keep going. And then the next candle's expectation, once it gets above this, should only be a wick into that. And we should continue to trust the delivery in this being balanced price range, bullish, being respected. So balanced price range here because we got above, market maker buy model completed. Again, that's a balanced price range. We have an order block here. We have respect to this. There's that little new week opening gap in there that it's kind of hugged the top of. So we'll see what it wants to do in regards to that. And then again, we have the quarterly wick in here that we talked about. If I could Move it to the left. Okay. We have the weekly low here. That's our new weekly low. And then we got a new weekly high. So those liquidity pools are significant. Again, we're in a balanced price range. So if it's going to keep going higher, it should not reach the midpoint of this previous range. If it does, we then go from buy model being completed to then sell model aiming for these equal lows. Okay. Take that off. So does everything make sense so far? Again, if this was the NASDAQ, a lot of people get upset that I look at these assets. It's like, dude, do you not like sit and listen? Right? Like everything that I talk about on this asset can also be very helpful, or is very helpful, and it's universal for the other assets. So anything you learn here can be applied to NASDAQ, S&P, crypto, it doesn't matter. But this is very important to this process for us being consistently on point with what we think price is going to do, or anticipating moments where price just is not going to be favorable, really. And that's observed by seeing the intermarket relationships. Okay. So this right here will be a line in the sand for me. If we think about it, we have a gap, we have an order block, and lows. So if this was to displace after taking stops, rejecting from this monthly wick up here, and dollar does look like it wants to continue to go lower, we may be seeing a market maker sell model in the dollar, right? From these equal lows, consolidation, accumulation, breakdown, a reversal into that should not break the down candle here. It should use that and then go lower. And then once it gets below this, use it again and go lower until we get down to here if it is going to be a sell model. To support that with a high level of conviction, I need to see, or would prefer to see, that price starts to fall in the yields. And then we start to see a recovery or rally in the bonds, which are these assets. These assets, if the yields have a heavy positive correlation generally with the dollar, or an influence over the dollar, then the bonds, right, the T-bond futures, right, here's the symbols for all 6 of them. So these are the T-bonds, okay, and these are the yields, 30, 10, 5, and then same thing, 30, 10, 5. And why we have all 3 of them for each of these assets is because we're trying to look for SMT, right? If there's ever any SMT or Kraken correlation and these assets are going to turn, again, they have that much of an impact on the main assets that we like to look at, like the dollar, the currencies, and the indices. And again, it just takes a little bit of time to study this, or just a couple of these live calls, looking at these relationships to really convince yourself about how important these assets are. Okay, they're not obviously the only thing that's going to be useful to you, but again, it's a layer of context. It's a layer of clarity. And it makes it so when you think, oh, the NASDAQ, I think it's going to go higher from this bullish order block, it makes that statement a lot stronger for you to trust it. And then, of course, because of this being the reality about the risk on, risk off relationship being important, obviously you'll see that it's consistent, but it takes a little bit of time because we're going off the higher time frame. You don't ever go to, well, I shouldn't say never, but I don't generally go to anything lower than the 4-hour on these assets because I'm using them for a very specific function, okay? Just to help confirm or have back-end clarity and context for whatever I'm looking to see in the currencies and the indices, okay? So just a piece to the puzzle, okay? So again, this here will be my invalidation. So if we were to see that, if we were to see that this thing was to break through this, because this is supposed to act as a BPR, because we got sell side and buy side delivery, we should see it respect the upper 25 to 50%. Because that's the case, we got to keep this in mind, okay? And when it breaks that, we also think about the 3 PD array rule. So we got structural change, but then we also have 3 PD arrays being violated, which shouldn't happen if we're going to be bullish, right? If it is going to be bullish, we should respect levels like this. It should displace, so go lower to go higher, come back to go lower, to go higher, buy model, failed sell model, buy model, failed sell model, buy model, failed sell model overall. And then respect the upper 25%, upper 50% of each PD array. Maybe it takes out one or two, that's fine, but overall the context should be staying within what I just mentioned. And once it stops doing that, you know that you're ready to possibly consider potentially changing direction and going the other way, right? Like this in here, right? Price came all the way lower below that. So the expectation was to see if this could retrace and then keep going lower, right? But look what it did. It ended up failing that, creating a type 2 dealing range going to the buy side, right? Or well, type 1 dealing range, a breaker. And then it respected the breaker and then broke 3 PD arrays to the upside, right? This got broken, right? These up candles, the swing high, and then the fair value gap. And what happened? It rallied up after taking stops, came down, respected it, and then what? It started going higher, racing for the buy side. This was also a quarterly bullish order block, that orange line. So just to reinforce the emphasis on how important some of these very macro levels are, I mean, you could see that was the origin of this move after 3 PD arrays were violated and we accumulated in that area. And then price was off to the races for a big move because it's a big time frame, big context, again, which results in big moves, right? So it's very important stuff. Let me see. When we say dollar and NASDAQ go in the opposite direction, so yeah, that's a very, very good question. So it's a general reverse correlation. And if we want, it's not going to be perfect like EU and GU in the dollar, but it is going to have the overall sentiment being opposite. So if the dollar is interested in going lower, we should see the indices run higher, right? If I could go pull this up. Okay. If the dollar's tanking lower, look at the sentiment. Maybe not candle for candle correlation, but the sentiment is opposite. So if this is bullish, we should expect that the dollar is going to be bearish. Not like GU and EU and the dollar. Sometimes it's just like that though, but it's not like that every time. But you want to look at the overall sentiment. Is a dollar bearish or bullish? That's the key. Whichever one that is, the NASDAQ and the indices should do the opposite. And they'll have their own little story. It'll look a little, well, not asymmetric, I guess, right? It's not going to be perfectly symmetrical in terms of the opposition they have to one another. But the sentiment is absolutely something you want to see as an opposite relationship. Speaking of that, I want to actually pull this up real quick before anything else. Let me go to there it is. So if you haven't taken a screenshot of this, you want to take a screenshot of this. Okay. It's very important stuff. Take a quick screenshot and then go study this stuff every week. Okay. And then you'll start to see, okay, like the symmetrical market doesn't mean that every asset is going to move perfectly, right? It means that the overall sentiments are the same. Some of them, like EU and GU and the dollar, they should be pretty lockstep. Like EU and DXY, they're literally opposites. Like candle for candle opposite correlation, right? But the NASDAQ, it's got a reverse influence or a reverse relationship sentiment wise. But yeah, that's a great question. I appreciate you asking that. But yeah, so hopefully that answered that question enough. So again, when it comes to the yields, I want to see if the midpoint can be traded through. If it can, then we'll go lower. That'll support the dollar going lower. If in fact we're going to continue to see this look to target sell side liquidity, these equal lows potentially. But if we stop right here, notice how we're inside this bullish breaker on the dollar too. So if this stops here and then goes higher, then we're going to be in correlation with this if the yields can keep going higher. So we got to see price make a decision in here. We're in a fair value gap, volume imbalance, aka new week opening gap, and then we got down movement, up movement. So sell side to buy side. We got the upper 25% of this high to that low. That's that completed market maker buy model. So market maker buy and sell models, when they get completed, are classified as BPRs. So the upper 25 to 50%, if we're going to keep going higher relative to this previous range, we should not see price get down into this. And that's why this is the buy side invalidation, because if this breaks down, we'll start to have multiple PD arrays get violated. And then we'll also have BPRs starting to not hold price, and then look to see it go lower, right? And then we'll frame BPRs and everything else going the opposite way, right? But yeah, so up until that point is confirmed, until this thing starts to break and the yields start to come into correlation, which sometimes they stay cracked in correlation. So we just got to go off the assets we observe. Like if this thing keeps going higher, I'm going to continue to just look at the dollar with the other assets together. As long as the correlation stays the way that it is, we'll be able to still trust it. Just because one asset is not in line with what it's supposed to be doing, doesn't mean that all the other assets are not going to be correlated the right way. Sometimes there's stuff happening within certain asset classes on the back end that we're not privy to that may be throwing things off a little bit. But someone's lying. Is it the bonds and yields that are lying, or is it the other assets? And only time allows you to determine which one is going to be lying, right? So you just go put the asset to the side that seems like it's out of correlation with what the others are doing. You keep your eyes on it and observe it, but you don't make decisions based on that one asset that's off. But it is something that elevates the risk, because the other assets could be lying and we don't know, right? So it's just some perspective to have when you're doing this analysis, looking through these different assets, internalizing what they're doing. So again, and every time you look at a chart, but this is pretty much my opinion for this asset, and if this is going to continue to go higher, this will go lower. If this breaks and takes this out, this will end up going higher. Okay. And this has a correlation with the dollar, reverse for the other assets. This has a correlation with the other assets and is opposed to the dollar. Okay. So with the dollar going lower, this should go higher and the yield should go lower if it's a trustworthy trend in the DXY. But we're kind of in a range. So it makes sense that there's a correlation issue going on. But it'll only be for a little bit, right? So yeah, when you're looking at assets at any moment, one of the first things you got to do is obviously look at the news, right? But aside from that, when you look at the chart, when you pull up the chart and it's naked like this, the first thing you want to look at is stuff from the liquidity mapping list. You want to look for the most recent weekly high and low, Friday's high and low, the last 3 days highs and lows, right? The last 3 weeks highs and lows, right? To see what's around. And then close proximity PD arrays. In this case, right, we have these highs up here. We actually have this high here in the balanced price range, like I said. So that's a close proximity PD array. We also have the levels that I mentioned in here, right? The fair value gap. We have the wick, volume imbalance, and the swing low, right? And the down candle that we're trading into. So all of these levels are more significant than anything over here, at least for now. But it's a little list of things you're looking at. Near-term liquidity, so previous days highs and lows, weeks highs and lows, maybe a month high or low if it's in close proximity. You want to note the previous monthly high and low, and then anything that you can zoom out and see is in close proximity. Like, for example, this wick here from the monthly chart, right? That's in close proximity to where price is currently at, right? We're using that lower 25 to 50%. So this is true with any asset. If this was the NASDAQ and it looked like this, I'd be doing the same thing, which again is why even when we're looking at these assets, there's a ridiculous amount of value for you to gather and then go apply to crypto or whatever you like to trade. But it's a very simplistic view. It's not every single PD array on in the library of ICT concepts. It's not things from way down here that we could care less about that pulls our attention, right? It's what's happening currently right now and what liquidity could be targeted for the next week. And that could be this low here if it breaks down to look to target the midpoint. It could be this high. I think more so it's going to be this high until proven otherwise. What we do see here as well Yeah, does that make sense, what I just talked about, what I just mentioned? I hope so. It's very simplistic stuff. It's not overly complex, but people like to overlook simplicity for God knows what reason. And I think it's a lack of experience. They want rocket science, or they feel like they're not learning. But, that's not something that's the driver behind profitability or consistency. We know a lot, but not every moment has to be scientific. Okay. But when it comes to this asset here, we got the change in state of delivery. So this is an early sign that we may look to gravitate to this. And we have this order block. So the only way that I will be somewhat confident, I don't have to see it break this. If this breaks this candle's low here, the open price and the low, and its displacement, we'll then have a balanced price range, inversion fair value gap, and we'll have one change in state with a second change in state, and the inversion fair value gap, which will be a third change in state of delivery. So that puts this in the realm of high probability. So again, if this was the NASDAQ, I'd be thinking the same thing. And if you sit here and think about what I just said, hopefully you could see how dynamic this can be in helping you determine what price is going to do. And this is a daily chart. So if that happens and it's a daily, what do you think the next couple of days is probably going to do? What your bias should be for the next couple of days? It's going to be bearish. If it does not break this low and it does not invert this fair value gap, and this retracement into this inversion ends up displacing and we get above this candle, any return down into that allows us to reliably target this high, and then maybe even get excited enough to come up here and take this high, or simply attack this monthly wick and the quadrants and the eighth levels as it looks to keep going higher, right? So if this asset here was the dollar, was the NASDAQ, was any other asset, I'd be thinking exactly the same, identifying the exact same things that I've just mentioned. I want to drive that point home aggressively, because for whatever reason, people look at this chart and they think, oh, well, I don't want to watch this chart. Look at the NASDAQ. And it's like, do you not realize like what's going on here? But yeah, so hopefully I made that clear and you guys learned something right there, because it's very important. If you're ever concerned about whether something's going to continue in a direction or continue a bias, or pretty much reverse, you want to use my double change in state theory. Okay, because if we have one order block and then a second order block that gets taken out, that's some of the highest probability signatures in price that's going to tell you that the bias has now shifted, going from bullish to now bearish. And maybe it's just short term to clean things up. And then maybe, that's just a retracement on the weekly chart. And then it starts to turn around again, but gives you a double change in state back in line with what your overall previous objective was. Then that's telling you in some of the clearest signs that we're going to now go back in the other direction. So this double change in state theory is something that I teach that is highly effective. And again, most people aren't using it because they don't understand what they're talking about, or they haven't discovered it. And ICT hasn't mentioned it. He's never said that. So it's something that's unique that I've discovered, right? Let me see. Sounds like a great addition for scalping on 5 minute, 1 minute. Yeah, no, it's fractal too. This is a fractal idea, but it depends on what time frame you're on. If you're on the daily chart or anything above like the 1 hour, 4 hour, should I say 1 hour? Yeah, 1 hour can be classified as still a pretty high time frame perspective. It's like intermediate perspective. But when you're finding these things or anything else on that higher time frame, it's more significant to the context of the narrative. When you're looking at it from, say, the 1 minute chart, if you're trading with the narrative on that higher time frame, then it can be really effective identifying these things and any other things to help you get in line with the trade setup, or to trust the overall delivery, right, with whatever direction you're aiming at. But you want to be careful, right? Because just because there's a double change in state on the 5 minute, it could just be changing state, like a double change in state to retrace on the daily chart. And then you look for a double change in state back in line with what that daily chart and weekly chart is doing. Does that make sense? Give me a 1 in the chat if that makes sense. Good morning, Emmanuel. Appreciate you hopping on, bro. Okay, one. Appreciate you, Fritz. All right. So yeah, again, I hope this makes sense. It's ridiculous value that people, again, nobody talks about it. Maybe some big name will find this video and then start talking about it, claiming that they discovered it, but you know, it's kind of the nature of this. But whatever. So yeah. Yo, what's up, Omar? I think that's Omar. Omar, is that you? I think it's you, huh? All right, for sure. I appreciate you guys. So hopefully everything is clear as far as what we're looking for with this. We got our invalidation levels for the weekly perspective. And now we also got the double change in state that'll give us an early sign that this middle lower part of this previous range will then be targeted. Trendline liquidity is there as well. So that'll be our contingency plan. If it does give us that double change in state, my eyes go right to there. And then we could navigate something going into that. And then depending how it would treat that, right? If it did drop, depending on how the week transpires, we'd be able to then, you know, adjust if needed. But yeah, so that being said, let's move on to the dollar. So if we pull up the dollar chart, I know you guys see there's a lot of activity in here. We kind of just talked about the dollar. It's retracing into a bearish breaker. We do got a breakdown here on the monthly chart. On the weekly chart, we do have that change in state of delivery here. So if we see, going back to what I just mentioned, if we can get price on this weekly chart, let me actually clean some of this up. Some of this stuff is old. So this is a previous range in there that I was using as a BPR, similar to what I was just talking about. This is just a testament to the fact that everything is universal. What I do on the other assets can be used on every asset, okay? Unless I explicitly say it's specific to whatever asset I'm looking at. But we see how this thing turned out to go lower. We ran up. It was retracing into the BPR, respecting the upper 25%, respecting the fair value gap, the volume imbalance. So that is one full range in there. Price came down, respected it, tried to run up again, but the rejection block said, nah, not today. And then it broke down, changing state of delivery here. So now, if we're not confident just yet in this looking to go bearish, then we would have to just simply wait for a double change in state of delivery on this weekly chart. You can also see it kind of clearly also on the daily chart, right? We did map this out, and clearly the narrative continued to drop lower, attacking these equal lows here. We now have 3 equal lows. So I'm even more confident that we still should be able to get price to come down through this. But if you wanted to, you could wait, going back to what I said on the other asset, wait for a second change in state. Like if this was the daily chart, right, this weekly view here, if this was what the daily chart showed, you know, that's pretty convincing. We have one change in state and an inversion fair value gap that closed below the inversion level. That is a form of change in state of delivery. It's also a form of a BPR once it closes below it like that. When it returns back into it, it should respect the lower 25 to 50% of that inversion, but preferably the lower 25%, because that'll justify pretty solid weakness in that asset, right? And in that delivery. So something else that we can also observe outside of that discussion is the fact that this is a market maker sell model. If we are going to continue with this being respected, this change in state turns into a second change in state. We have accumulation, and consolidation with relative equal lows. Okay. So with that being the case, if it starts to show respect to this, ideally on this weekly view, we don't want to see price get back above this. Okay, let me actually, we have a monthly wick quadrant in there. I just don't want it to be so busy, to be honest. So I got this weekly market maker sell model. Why is it not changing the, okay, there we go. So you've got that weekly market maker sell model. We're inside that accumulation. So I'm very curious to see how price is going to want to deal with that. Let's see, 86. Okay. Okay. So we do have that lower 25% of the monthly wick. But again, we also have this little market maker sell model, big market maker sell model. Coming off of the rejection block, coming off of this, right? You guys know that we talked about this, possible accumulation, manipulation, distribution, targeting the monthly fair value gap. The rejection block that we outlined and the wick lower 25% denied price's ability to get up there, and then we changed state of delivery, and then we inverted the fair value gap. So it's aggressively repricing lower into this previous range. So last week I talked about how I wanted to see price go up, preferably not even hit this wick midpoint, stay in the lower 25%. Price actually did even less than that, right? It couldn't even get to the 25% of that wick. We still respected this inversion fair value gap here. Not only that, we're also showing massive respect to this with this wick in here that was created inside of this price delivery. Okay. And now we got, again, the market maker sell model. It looks a little bit more clear when you look at it from this perspective. Something you could also consider is the fact that this run higher when it chose to go lower and we broke the 50%. Right there, that was a trigger for market maker sell model anchored with the smart money reversal up here at this weekly wick rejection block area. Okay. And we got the strong displacement because it's a higher time frame PD array, refusal to get up here, and then a break below the midpoint of this, disrespecting the bullish breaker here on the daily chart. And then price ended up just taking off from this inversion, creating second stage distribution delivery, breaking through that low. And that is also, again, inside of this potential market maker sell model. If this is the case and we do end up, coming down, into these levels, then this will have proven to be a smart money reversal. Okay. Actually have previous week's high here. So I think I can remove that. I think we've earned the right to remove that. If we could get the weekly high. So that's the weekly high from last week. I'm not even going to put another label there. We already got these three lows. I mean, that's just so obvious. Like, it's so obvious that it's just resting there. That doesn't mean, because it's obvious, that they aren't going to want to maybe come up, maybe wipe some of this out, right? They may want to come up there, clean some of that up. We'll see what happens in regards to that. Let me paste that. So, but we do have these three lows down here. So I'm pretty confident that as long as we could stay below this candle's midpoint, that we will end up seeing price continue to go lower. Okay. So we got that order block, 50% level. So we're just going to have to keep tabs on that, okay? And then again, once it closes below this accumulation level, right, high to low, the last down candle, or the lower 25% essentially of this whole range, when price breaks through it, when it comes back into it, it should be respected. And then when it, if it does do that, and we do end up going down below this one, we'd use the same thing. But this down here will be a little bit different. It'll be second stage distribution territory. And I think that if we can get down there, this is a very logical target to reach for, right? Into these equal lows. But again, that's pretty far away. It may take, another month or two to get down there if it chooses to get down there, unless we have a couple of weeks like this. Right? All it needs is like one or two of those. So CPI is going to be very important. CPI, may trigger the interest for it to get down here. Maybe CPI gets us down there. It's a strong enough news event to do so. And that obviously in return will send the indices higher. Hopefully by that time, we get the correlation to fall back in line. With this justifying further sell side, I can tell you that if this thing kicks back into correlation, that is going to supercharge this to really be able to get down there. When it's cracked in correlation, sometimes the price moves are reluctant to really expand and be a trending environment. That's pretty much present when there's a crack in correlation, kind of less follow through type of delivery. When everything is symmetrical, it is very fun because you catch these big runners, price swings that are just ridiculous, which we've seen a lot of ridiculous price legs, just crazy 1,000-point moves. I mean, the last 2 weeks, the average daily range was upwards of 800 points each day, give or take, a handful of days in the last month. So crazy volatility these days, beautiful opportunities, and we're here for all of it, doing pretty well each week with this overall process. So yeah, we'll see what the dollar does with the midpoint. I think that it could come up here if it wants to. That wouldn't upset anything. But once we break things like this, or if it gets back above this fair value gap and then reclaims it and then starts to break, if we get this high to that low, 50% is right there. So if we were to get up into this area up here, there'd be no real reason to try to think shorts are going to even be trustworthy anymore. But you can tell that that's a pretty far ways away for me to get away from my higher time frame narrative. But that's the point. Bias can change on a daily basis. Like we can get a retracement to then go lower. It could consolidate to go lower, or it can reverse entirely, right? But we need a lot to get away from our narrative that we determine, right? The narrative doesn't change on a daily basis, but the bias, they're separate things. The bias can change. The narrative is basically what is happening in the macro perspective, right? What is price reaching for on the weekly, on the monthly? And then how does all that stuff correlate with the quarterly and the daily chart? Okay. And whatever operation is taking place around those perspectives, that's the key to narrative, right? What is it doing? Are we in a higher time frame market maker buy or sell model? Are we in a higher time frame power 3 delivery? And we're in just some phase of that going in one particular direction on the higher time frame, then we stick to that and try to determine what phase we're in. And of course, every day can kind of vary, depends on what it's doing. If there's displacement, it may want to retrace before it continues to displace again. But that does, just because it retraces on your bearish narrative doesn't mean that you shift your whole entire objective and toss away something that you determined on that daily, weekly, monthly, quarterly chart. You have to see your validation levels get taken out. Structurally, it has to change for you to then get in line with the other direction. At least that's how I do things. And that's, a lot of times why we're able to stick with our narrative in the face of price given dramatic retracements that are simply just that, retracements. Okay. And then we get back in line with it, right? And then adjust when necessary. But yeah, so you want to start to cultivate this mindset when it comes to bias and narrative. You want to understand the difference. And I hope being in this community, you guys see that, see what those differences are and how it's okay to stick to a narrative. And guess what? If you're wrong, you end up being wrong. And maybe you could have told sooner, so be it. But what I've learned over the last 7 years is that this is extremely helpful. Sticking to your bias is something that ICT says you got to do. He says that when you're on the higher time frame, you got to learn to stick to your narrative. Okay, you got to stick to what you believe price is going to do. And then inside that narrative, yeah, there could be buys and sells. So bias and narrative used as a factor of power 3 is a great way to look at it. Yeah, 100%. 100%. If you can determine if we're in a bullish power 3 or bearish power 3, or if we're on a daily, weekly, monthly market maker buy or sell model, that gives you a framework to then justify even further what the narrative is going to be. What direction should I favor most, right? So those are very helpful. I talk about market maker models as a sentiment tool many times. So, it kind of helps you gauge what you think price is going to do overall. Okay. So yeah, very important topic. Appreciate you, Fritz. One thing, if you guys do like the video and, value what it is that we do here, you get a lot of value from here. Don't forget to like the video, subscribe to the channel, spread the word, right? If you have anyone that does trade that you think could get value from this community, it's definitely going to help me help other people. And then they come here and you guys are amazing as well, right? So, what memory capacity of my computer? It really just depends. You don't have to have some like supercharged gaming computer, but if you're going to run multiple tabs, you want to have a pretty reasonably powerful computer, by the way. Like I built my computer, spent like $3,000 on it. You don't have to do that. You could spend like $1,500. But you want heavy RAM, at least 16 gigabytes. I have an external hard drive in terms of memory that has 10 terabytes. So anything and everything that I have can go in there, and it's been 5 years and it hasn't filled up. So, and I do videos. I record my videos and share it in my own folders as a journal, right? So that when I look back, or if my future kids or my brother or someone wants to look back on it and God forbid something happened to me, they could just pull that up and see what I do every single day, how I do it, how I think, all these different things, just actively engaging. And then me too, right? If I want to review things on a particular day, I can go in and get a feel for what I was really thinking, what I was really doing, rather than, oh, I called it correctly, guys, right? Like, see. So yeah. So hopefully I answered that question. You could just look up PC builds for like $1,500. ChatGPT is also very good. You can use it for that as well. If, you take this advice and you maybe still have some like concerns, maybe you have some stuff in mind. I'm not obviously a computer guy, but I just know that from what I was researching before I built my computer, you don't need like a supercharged, insane computer. I obviously went a little bit overboard to future-proof things, so I don't have to buy a computer for a while. But, I still bought some incorrect things, honestly, some stuff that's a little bit older. But hey, it works. Not really concerned. Maybe I'll upgrade at some point, but, what I have is reasonable. So, yeah, don't spend too much time being too concerned about it. It's not too dramatic. Again, you don't need like a crazy computer. You just need something that has at least 16 gigabytes of RAM. If you want more, you can. RAM is very important. And then, of course, have like a terabyte or two SSD card, and then have an external hard drive as well. Doesn't have to be 10 terabytes, but if you never want to have to buy another hard drive, you want all your trading stuff from videos to recorded executions to personal reflection videos. If you're going to make content, I highly recommend a 10 terabyte. I think they're not really that overly expensive. Mine was like $200, but it's an investment that I've been using for the whole time I've been making content or anything like that, recording my videos as a journal for like 3 hours long, right? They're not like 20-minute videos that I record like this video, right? They're pretty long, and it still can sustain it with high quality. And I haven't even touched 25% of what the overall memory is, which is nuts. I didn't realize how big 10 terabytes was. But hey, I'm glad I got it. It was actually a gift to me. So I would have bought it regardless, though. So yeah, that's my opinion. So yeah, hopefully everything makes sense here. If you guys don't get any more questions, we will be able to move forward. But again, just in a nutshell, I'm bearish on the dollar. I want to see if we can hold this, see if the yields can fall in line with this. If it does, then we're going to see the yield, the bonds go higher, and then that should send the indices higher as well. Okay. So yeah, that's my opinion on the dollar. Hopefully you guys are able to understand what our opinion is. With that being said, let's move on. So when it comes to the currencies, if the dollar is going to go lower, I'm still going to consider this going higher. We have a high, a low here, high, failure swing. So that turns this into a, is that a gap? Yeah, it's a gap in there. So this whole range up here is upper. Let me see, can I break down a little bit? And so we got this order block there. We do have that gap in there, so that's definitely something to consider. We also have this reclaimed bullish fair value gap. The price is respecting that pretty nicely. We have an order block here. We have an order block there. So we'll watch and see how this gets respected. The midpoint of this, the high here to the low, midpoint of that should not be traded too aggressively through. Right, price should be able to come down into it and then bounce. That's what I'll be expecting, at least. And yeah, same thing with this. If you guys notice, I talked about this literally weeks ago as a threat to this continuous down movement. Literally talked about this when it was created, when we were getting down into here. When we were talking about how this could continue to go lower, I said that this is a BPR, it should be, but because there's that little inefficiency in there where there's no candle, that may be a problem later on. Obviously, it took a long time before it ended up getting there, and we didn't have that as a main focus until this happened, right? Because then it really became a target because it's inefficient. But it's ironic that it went right up into that. And again, if you remember, if you go back to the video here that I did on Sunday, June 21st, you'll see that I explicitly mentioned that. So you could just go back and do your research and see how I was looking at that. Don't just take my word for it. But obviously we came right up into it, and ironically it stopped right there as a target. It's still a little bit inefficient. So again, we're probably going to keep going up, especially if the dollar keeps up what we talked about with it going lower. So I'll expect that this also could be looked at. It's relative equal highs up here. So that high is going to be significant. Take the high here to the low, 50%, 25%. And so this is a market maker buy model as well. We have the origin, accumulation, reaccumulation, smart money reversal, got a breaker, delivery higher, overtaking the first accumulation, second accumulation now turned to second stage distribution. So I think that this will be able to, hopefully, if the dollar keeps going lower, rally up aggressively with CPI, get us up there, take it out. So that'll be my expectation. If we can't get that to take place, maybe it'll just consolidate, but we'll have to just wait and kind of see in that regard. But gun to my head, I'm thinking the price is going to get up there. We still have a little bit more of this, so we got like a tiny little bit that's inefficient still. So it's going to have to deliver in there. But I'm going to stick to that, right? And what's going to shake me out of this bullish delivery, see, I even mentioned this, needs to stay closing above when it traded back down into it. I talked about this last weekend, actually. And we could see it traded lower. We couldn't even get to it. We couldn't even touch that price level. That's the equilibrium or midpoint, 50% consequent encroachment of the order block. Came down, changed the delivery right there. Price wicked into it, respected the midpoint, rallied, came back down one more time, respected it, rallied, came back down one more time. We're still respecting that bullish order block and this one in the upper 25%. This is more significant than this one, to be honest. It's literally overtaking it, right? This one eats this one. So that is the more significant one, upper 25 to 50%. As long as that stays intact, this order block stays intact. And as long as that order block stays intact, we will continue to go higher. And we got the low here, low here, low here. We have new week opening gap right there. We have a fair value gap in here. We have a gap in here as well. So if this was to break these lows in here, we'd have to be cautious. And then once it closes below this, that would put us in position to then target sell side liquidity. Like this low, these lows. That's a rejection block right there too. So if we were to break down below these lows here, this one would turn into a potential breaker. If it broke down through that, came back in and respected it, then displaced, my objective would be the 50% there, and then the rejection block, and then the low. But again, that's all contingency. My gun to my head opinion is going to be, we get an open retracement, rally up, show little respect to this wick. The midpoint right there is going to be important. If it gets above that, then again, that's further justification that we may look to come up and take this, right? Fill in the rest of that. And then filling in the rest of that would lead us to this. Okay. That is right there. Rest of that gap, and then it's an order block too. So yeah, and we got a rejection block there. So this is a lower time frame rejection block. I think I'm not even going to keep that on the chart. It's not relevant at the moment. What I do see is that this was a market maker buy model, which we talked about. Everything was already outlined that you see on the chart. Now we have this one too. So this could end up becoming part of a market maker buy model. Okay. Let's see, is there any accumulation we could look at? Kind of already had it right there. You notice how this right here, when it got above this accumulation, how the retracement never broke the lowest point of that accumulation? That's part of our rules when we're watching a market maker buy model. Once it breaks through this level here and you think that we're in a buy model, it can retrade back down into that accumulation. Preferably, we stay in the upper 25%. But as long as it doesn't break that entire range, in this case to the low extreme, price will keep going higher. And we could see how that's just beautifully unfolded. And if we look at this lower time frame, I never look at these lower time frames on Sundays, but just want to make a point. Sell side to buy side, that's a market maker buy model. Sell side to buy side, that's a market maker buy model. Failed market maker sell model in here. Failed market maker sell model in here. Failed market maker sell model in here. Buy model, buy model, buy model. Even this, it's a little buy model. Right? And then this high, low to the high, it's a buy model. Right? This right here, sell model. Interestingly enough, we did complete this as a buy model. Sometimes they complete, but just, to take out liquidity and then set up the other way. Okay? Sell model. Okay? Buy model. Sell model. And sell model. So hopefully that's enlightening for those that may have never seen me talk about it like this. But market maker models are freaking everywhere. Okay? Like I say, everything comes back to these concepts. Okay? So again, hopefully everything's clear as far as what we're looking for in the currencies. We'll see if this can keep getting up here. Right? And until proven otherwise, with this breaking down, we're not going to feel the need to really go against that opinion. I would have really liked them to take this out first. I don't like them doing this, leaving this type of stuff, but it is what it is. Dollars started to really accelerate. So this one had really no choice but to run higher. So yeah, this was a weekly bearish order block. It still is a weekly bearish order block, but we'll see from this weekly perspective too. Think about it, sell side to buy side. If we get outside of this or take this high out, this is accumulation, and this is the origin. So that should be a buy model. This low to that high breaking down. You guys remember, if you've been here for a while, I called this as a sell model. And then this is a failed buy model, right? Inside of all these, all this price action, obviously, if you go to the lower time frame, you see a whole lot of these in every price swing. But hopefully I'm driving the point home enough with how important market maker buy and sell models and power 3 are. Because power 3 is also happening at every turning point as well, pretty much, right? But I'll leave that for you to go study on the lower time frames. But yeah, so midpoint is right there. We'll see how it opens up and if it can continue to respect the buy side. If we get up above these levels, again, we got a big buy model happening as well. Okay. So yeah, that about does it for the currencies. Would it be reasonable on our trade for the currencies as silver bullet? So AM and PM session is not relevant to the currencies. AM and PM session is not, it's only relevant to the indices, from what I understand. The currencies have a different time element. There's some stuff that's different about the timing with the sessions. Currencies end by London close, especially Euro and GBP. So if you're trading those two currencies, if you do decide to do so, your max cutoff is 11 Eastern, 9, 10, 11, 9. Is it 9? London close 9? I think it's 9. 9 a.m. Pacific Standard Time is the cutoff. That's what I used to cut off at. That doesn't mean that movement's not going to happen, but the big moves, they take place when it comes to the London assets, generally by the end of London close. New York session obviously can have a flurry of price delivery, but once you get beyond London close, you probably want to be out of the market already. So within that first hour or so, hour or two inside of the currencies. But yeah, silver bullet model. The silver bullet for the PM session is 11 to 12 p.m. Pacific Standard Time. That's the silver bullet time window for those that don't know for PM session. ICT has talked about that. So for those that only can trade the PM session, you can use that time window as well. Just start backtesting PM session for currencies. Yeah, I would be a bit cautious because, again, there is some stuff that's specific to the currencies versus the indices. And that timing element is definitely one. They still have macros. They still have some stuff that overlaps. But when it comes to the breakdown of the sessions, it's a little bit different. It's a little special for the indices. All right. So yeah, hopefully you guys got value so far. Don't forget to like the video, subscribe to the channel if you haven't already. Appreciate you guys. Helps YouTube know that we are definitely worth listening to. I think we are, right? And I hope you guys think so too, because I don't want to waste your time, right? But yeah, that's my opinion for the Euro and the GBP. And if we scroll over here to the indices real quick, take off some of the markups, we can clearly see what has taken place, right? I just, in my opinion, see a giant accumulation, manipulation, distribution. We have a bullish breaker here. So as long as price can get above this and then return into it and respect it, we'll still continue to see this thing keep rapidly going higher, especially with dollar trying to tank. And you could see what we have done. Price accumulated, manipulated, hit a higher time frame fair value gap that, again, we outlined. Go back and look at my videos. We have literally talked about this whole entire move. I called this going down into here when we closed below that wick, right? The midpoint, or just simply on this time frame, got below it. And the daily and weekly chart were putting closures over that monthly wick midpoint. We targeted this, and then we blew through that, and I said the deepest we should go is down to this high. And isn't it ironic? It went down into that. We couldn't actually get perfectly to it, so it was a little bit off. But isn't it ironic how it hit that and we've turned aggressively? It's very interesting how things that we outline are just pretty flawlessly working out. Again, we're either the luckiest people on the internet or ICT. There's something to it, right? So yeah, we do have SMT up here, which is somewhat of a concern because if like the bonds start to go lower because the yields start to keep going higher or continue to go higher, and maybe the dollar bounces from the bullish order block here, maybe if that takes place, it could end up becoming an issue later on, but we'll have to just wait and see what happens. So I did mention there's a monthly SMT at the lows here too. As it was going lower, I said that may trigger in a bounce. Ironically, price is dancing to the tune we want it to dance to, right? So we can clearly see price is now breaching this. This is our market maker buy model accumulation phase. I talked about that. We have a fair value gap in here. It didn't have to come all the way down and close that entirely because, again, it's accumulation to distribution. We're seeing that that's the case right now, right? Accumulation, right? Getting broken through in a buy model after a rapid displacement with dollar going lower. Map that out. We're trading into this fair value gap. We're respecting the upper 25. The upper octant exactly got respected. One thing you want to keep tabs on right here too is this beautiful rejection block. How beautiful is that? All right, so that rejection block on the S&P looks pretty nice. And again, we got these equal highs up here. It's pretty interesting how the dollar has those equal lows and the NASDAQ has those equal highs, huh? It's kind of like it's telling us what it wants to do. Right? We're breaking things down with these conceptual ideas, and for whatever reason, it seems like it's telling us what to do. It's like we have a crystal ball or something to make clarity happen. So we'll see what happens. I want to see it get up here. Unless this thing gets below this accumulation level, I'm going to keep pushing this higher. Oh no. Just push my desk and everything shook. Wouldn't that have been something tragic? I hit my desk the wrong way and everything collapses. Like, dude, I think that thought just ran through my mind. That was a little terrifying. Yeah, don't panic. Don't panic. Don't panic. So yeah, honestly, looking at price like this, given all the things that we just looked at, given all the stuff that we've talked about, given what I've literally just outlined right here in 2 seconds, would you guys say that we have enough information to determine where price is going to go? Does it make sense what our opinion is here? Do we have enough information, right? Is there enough PD arrays on this chart? Let me actually remove some stuff. Would you say there's enough information here to be able to determine with a high level of certainty, as much as you possibly can have ahead of CPI, that we have a logical target that makes sense to be targeted, right? More of a strong argument for one side or the other. Maddie said, yeah. And I would agree, my friend. Fritz, Omar, appreciate you guys. Glad you guys agree. So yeah, that'll essentially be my only comments on this, because I think that's really all we need. Looks like everything's good. SMT down here set up the bounce higher, dollar going lower, set up this. Now we got a market maker buy model to go off of, and we have the accumulation, which I used last week for price to trade into and then called buys on. Yeah, Maddie, that's exactly the truth. Low resistance liquidity run. That's what I see. So I think we're going to have a real good time. So we've already came down and tapped this. So right out the gate, I wouldn't be surprised if it tries to bounce. If we hit this wick like we are, and then we come back into the range a little bit, it's going to make me feel like they're going to use CPI to get up here. They may need CPI. If they blow through this ahead of CPI and dollar keeps tanking, then CPI may end up getting us up to this even larger target. Which let's actually go look at this real quick. Let's see. Third, second. Let's go from that. Let's go 20 bars back. Okay, so it's, let me see, 20 days. $40-day. So this is basically a 40-day look back. Well, I guess you could say 20. 20 was here. 40 is here, so intermediate term. So short term was this from August. That was the short-term high right there. 20-day look back is these, or 40-day look back is these equal highs here. And then we take this and look at 60 days. Oh, wait, whoops. Oh, whoops, I was on the 16-hour, my bad. So if we just go back. So yeah, 20-day actually aligns. Oh, sorry about that. I was on the 16-hour, I didn't realize. So 20-day, I think I talked about this the other day. I pointed this out as a 20-day. I was thinking in my head, like, what the hell? I could have swore that we talked about these equal highs being the 20-day. So 20-day look back. And we got 40-day look back. Lines up basically with this high. And then the 60-day look back is right there. That's our 60-day look back period liquidity pool, longer term price swing. So from August, the start of August, you cast it back. So there's different ways of doing it. The way that ICT teaches in his private group has to do with the start of each month. You can do it from this one right here, but I personally have gravitated and seen the most success in liquidity identification using the start of the month. Because once you start the month, you're looking for the target for the month, right? For the next 20, 40, 60 days. And generally you can just do it from here. ICT teaches to do it from the start of the month. All of his examples show the start of the month. He says that you can use it with this, but this, in my opinion, from what I backtested, because I backtested both from when I first started using the concept back then to today. And over the years, I just decided, let me just use this, right? And it just makes it easier for one, and it's highly effective, right? I mean, you could see how perfectly it aligns. And this is also what you do at a new quarter. You do it from the start of the month, and then you backtrack 20, 40, 60 days, and you can a lot of times gauge what the start of the quarter is going to reach for that first month, first 2 months. And you could see, I mean, look how perfect that aligns, right? And again, if you go back and rewatch some of ICT's videos about this, you notice on his examples, he's at the first of every month, right? So you can use current month or current day. But from what I've discovered, from what a lot of the charter students that I'm friends with also talk about, you use it from the start of the month. Again, for one, it's easier. Two, it's highly effective. And this is the analysis that we did from August 1st, when I first started talking about it, right? When I forgot who asked that question. I think it was maybe you, Maddie. What was it, Fritz? I can't remember who it was, but it was the start of August. And then we started talking about it. We did this analysis, and this liquidity targeting doesn't change. from the start of the month. It doesn't make it more accurate to pull it over here unless we've already exhausted a lot of stuff from this delivery. Like say this shot up like aggressively. Then of course you're gonna have to use potentially the 20, 40, 60 day look back in that regard from the current candle. But again, just to keep it super simple, right? For those that, want to use this concept, I personally don't use it every day. I use my liquidity mapping list to identify liquidity every day. And then I just couple that with every month, I'm doing 20, 40, 60 day look back from the start of the month. And throughout the entire month, you'll see that these references are utilized, right? So there's something to it. Of course, you can use this if you want, but my personal preference, how I teach it, based on what I've learned from ICT, because he gives a lot of different perspectives to use when it comes to all concepts that he shares. But I've just found that this is the most easy to use, the most effective, because sometimes current day, dragging it out 20 days, you may already have liquidity that's taken when it comes to current day. So that may put you in alignment with this. So you'll completely overlook things like this, right? If it doesn't perfectly align. But you see more often than not that things perfectly align when you use the month, right? The start of the month, previous month, so on and so forth, and then the future months. So, yeah, that's why I went back to this. This is part of how ICT teaches it, right? And you don't have to worry about, oh, well, this already exhausted something from current day 20 days ago. It already exhausted that liquidity pool, right? You don't have to worry about that because the whole month is using, these references. But every single day, right, this kind of neutralizes your need to do it right from the current day. Every single day, the liquidity mapping list that I give you guys makes it so liquidity identification is extremely simplified. Okay? So you don't even got to worry about the current day. You could just use the current month, and it structures you for the whole entire month, and then maybe even the next month or two, right? So yeah. So with that being said, I think we have talked about everything that I aimed to discuss today. I did forget that I have some stuff today. I'm being blown up yet again. So yeah, so I guess we'll leave it there. Can you explain which FVGs to monitor in 1 hour? So you want to just look at the most current fair value gaps, right? Anything that is in close proximity. If you have all this shit down here, you don't want to look at that. Who cares about that stuff? All this stuff over here, you don't have to have every single inversion fair value gap shown in price. You just have to have stuff that aligns with current price delivery. If there's something over here that's very big and obvious, sure, you could use it. Or if there's like one that's very close to price, like this one here, notice how I identified that really quickly, then you can use that as well because it's in the area. But even if I didn't have this, there's enough justification in this price delivery for me to justify that price is going to go higher. We have market maker buy model. We have a fair value gap in here. There's really not much in there except that and then some of this. Of course, you could go to the 4-hour chart and then you get this one as well. But all you need, think about it. If you're not concerned with all this stuff, because again, you don't need every single inversion to justify that price is going to go up. You just need, if you're on the 4-hour and 1 hour, what is in close proximity? If you're bullish on the higher time frame, reaching for these levels like we mentioned, what is in close proximity that can act as a gripping point as you climb this mountain to get to these highs up here? We have this one. We have a small one in here, but I like this big one in here. That's better. It's larger, more pronounced. So we could just simply use that one. Okay. And then when it comes down into it, you could refer to this, keep it in your radar as just a further assistant, right? A gripping point. But then you also want to have these other things too, like the wick, right? The wicks, how it's respecting those. If it creates an order block, how it's respecting the order block, upper 25%. Same thing with this fair value gap here too, when you identify them, right? Notice how it's hard to get confused about this in here. I have stripped away all the need for all these extra things from days ago. Of course, they will be useful in some ways, like something huge like this. It's clearly the high of that. Once it gets above it, could be, reutilized, because things don't get exhausted, right? We reuse PD arrays from a long time ago, but don't let that get you stuck and confused and not able to make a decision because there's so many things over here that you think you got to outline. You don't have to have every one of those to determine that this is going to reach for these highs up here, or to allow for yourself to have enough context to support it. We have a deeper context too, being a market maker buy model, lower to go higher delivery. I'd say those key components in that structure in the most current price delivery is more significant than anything over here would be in terms of it acting as a gripping point, right? It's like a leash. When you identify a market maker model, you have now put a leash on the market you're looking at, and you know exactly where it could potentially go. It's when it pulls you, you know where it's going because you have a leash on it. The market maker buy and sell model framework, in my opinion, is like a leash. If you could slap it on there and you're very effective in terms of pattern recognition with this leash that you put on the market, you're able to then follow wherever it pulls you to and anticipate where it's going to go. When you have a leash on a dog, you can kind of anticipate where he's going to pull you to. It's the same thing with this, right? I just thought of that analogy on the fly, by the way. I mean, I think that absolutely is an amazing analogy for market maker models. And that's why I love them so much, because it tells me what it's going to do. Now, wherever it goes, I don't give a shit. I'll be able to get in line with it. Let me see, Maddie. Okay, it makes sense. Okay, good. Because see, this is a benefit by having someone who has a lot of years, a little bit, or a lot more years than you, a lot more experience using particular things. Because again, when there's such a vast library of information and such an easy opportunity to be overcomplicated with so many complexities, it's very nice to have someone that can just like sift through things for you and show you like you don't have to worry about all of this stuff. You just need to have current stuff, and then later on when you get better, you can obviously refer to older things, but I mean they're just references. Something that happened over here excuse me is not going to be more significant than something that's happening right here. It's just supportive ideas from over here are going to support or should support something that you're determining in here. Okay. So that's how I look at it. Whoa. It just blinded me. Holy crap. So yeah, I'm glad it makes sense, Maddie. Appreciate the question, brother. You asked some really good questions, by the way, since you've watched what we do here. So if you guys can't tell my voice, I sound sick still. Still am sick. Fritz said I use FEGs in conjunction with premium discount. Yeah, that's a great way to do it too. But you just got to remember, sometimes if a fair value gap is in a discount and you have some scenario like this unfolding, you may not be able to get those discount fair value gaps. It may just be using the upper 25% of the range. So keep that in mind as well. If we're in a fast trending market, it's more likely, especially if we're very close, it's more likely that it's not going to have to go super deep into like the low extreme to the high extreme. In that case, to get even closer to price, you find the near-term most energetic price delivery, right? Aside from the low extreme. If we're way up here like this, if you measure out from here to there, you can get a better read, but that's still pretty deep, right? Especially if you were to take the low extreme down here. I mean, I highly doubt it's going to be able to get down there. So how do you justify what I call a rolling dealing range, a rolling premium and discount observation? You move it to the most recent swing that's aggressive, right? That was really aggressive. This was straight bullishness, and it's a swing low, a fractal low. So look at how beautiful that observation is. It puts a discount PD array right in your crosshairs. Right? This is called the rolling dealing range theory. When you're in a big range and you don't think you want to use the whole entire big range because it's not really likely, unless you're wrong, for price to get all the way down into here. If it seems unreasonably large for the range, you just go in there and you find the most recent swing low. that has energy to it, not just some, lethargic. I mean, there's nothing inherently wrong with this, but in this objective, it was so aggressive. When it's in a fast move, you don't want to look for the extreme high and low to map out the dealing range. That is the range, right? That is part of the range overall. So it has its place. But if you're trying to get close to the market in a fast-paced moving market, you want to use the most recent swing low that had energy. And when you map that out, you should be able to outline discount arrays like this, right? You use discount arrays or discount, premium and discount to identify PD arrays or fair value gap in particular, Fritz. And you could see how helpful this idea is. It identifies it perfectly. So when it gets down there, you're ready for it. And you can justify trust behind it. Because again, this is a trending environment. It's very fast. So you don't want to use these low extremes and require for price to get to a discount to go all the way down there. Sometimes it will. And that's just the nature of the probability, right? But when it's super fast like this, the probabilities are more so leaning towards using levels like this to map out your premium and discount. This is the full dealing range, obviously, low extreme to the high extreme. But at the same time, to get close to a trending environment and be able to identify premium and discount effectively, so you can do what Fritz just said and narrow in on discount arrays to buy at, or just simply discount arrays to target to then buy at. You got to use that most recent swing low. It's a fractal low. Notice that it's not just any old low. It's a fractal low. Higher low to the left, lower low in the middle, higher low to the right. Okay? And you can see how beautifully it lines up. Look at how nice that is. Obviously, there's something to this, right? So yeah. Nice. That's a great tip. Okay, good. I'm glad I was able to land that plane. Sometimes when I talk about this, it just stirs up even more questions. But I'm grateful that it kind of the plane landed, right? So yeah. With that being said, I'm gonna let you beautiful people get back to your weekend. Again, hopefully you guys got value. If you did get value, don't forget to share this live stream, spread the word. If you have anyone that is an aspiring trader that you think would benefit from this, I think every trader would benefit from being in these calls, because what we talk about is ridiculously amazing and it's proven. I'm not just, it's not ego, it's just a fact, right? I see you guys progressing and it reinforces my belief in just how much of the truth this is, because it's so transferable. And I'm not a rocket scientist, so I think it's very helpful when I'm able to describe things, because I need to say it in a way that makes sense to me. And I'm not a genius. I just never gave up. I've stumbled across the right people, spent a lot of money to get the right answers, and I'm able to now share that stuff with you. So I'm grateful that you guys can be a part of this, because you guys are, allowing me to do something that makes my trading even more meaningful to me, which is pass the blessing forward. So thank you guys as much as you guys try to thank me, right? So yeah. With that being said, God bless you guys. We'll be live again this week a couple of times. I think I'm going to run the marathon this week. So we'll be live. This is the second week, right, of August? Yeah. First week was last week. Yeah, this week's the second week. So I'll run the marathon this week. So I'll be live with you guys a couple of times. Those of you in my private group, obviously we'll still be going live as well, but it's going to be a couple less, like 2 days less in the privacy of Zoom in our private group. But I'll see you guys here too. I know you guys hop on as well. And hopefully you guys here on YouTube get to enjoy the experience this week, and we'll see how things turn out. So yeah, if you guys ever have any questions, just let me know. I will be happy to answer a question. Appreciate whoever just subscribed. Kurt, appreciate you, bro. Glad you got value. And yeah. So again, hopefully you learned some stuff. Let me know if you have any questions. Let me see. Would you ever consider? It really depends. It really depends. I'd have to have a good amount of people requesting it. It seems that most people are willing to hop on in the AM session. But yeah, it's been a long time since I traded PM session live. I've traded a couple times privately, but being live has taken it's been a pretty long time. You know, first time ever I did this back testing for the 16th or 16 hour. Then I slept. Again, I'm going to the 8 hour to back test. Yeah, 8 hour and 16 hour are really nice. Yeah, that's true, Fritz. I have noticed that. Maybe just because that's a fact, maybe I'll end up considering maybe a couple times a year. And I just realized backtesting and journaling, building your edge. Yeah, backtesting and journaling is how you go into a lab and create what it is you're trying to create. It's vital. It's so vital. People are lazy though. You know what I mean? So it's unfortunate, but it's kind of how cookie crumbles, right? We got to have people that are not willing to take it serious so they can fund the opposite end of our trade, okay, at the liquidity levels that we identify. And for whatever reason, they're sitting at that watering hole all the time, like ICT says. They're just sitting there and we're waiting. And for for a pretty long amount of time at this point, we have been able to absolutely crush it. You've been here for the last like 4 months. Just this whole year and last year, we have done spectacular things. I mean, it's been ridiculous. The amount of people that I've taught that have went on to be really, really good. I mean, it's pretty incredible, really. It really is. So, yeah. But with that being said, again, I'll let you guys get back to your weekend. God bless you guys. Again, thanks for the love and support. It means a lot. It's very meaningful that I help you guys succeed. I want to help everyone that I can who's willing to listen because I love this industry. This is what I do. It's what I'm going to do. Even on my deathbed, I'll still have a chart up probably. But hopefully I'm able to instill the passion into you guys, kind of show you guys what that looks like in me so you get inspired. And hopefully all these calls and all the things that you see us talk about and see them work out, hopefully that keeps that belief that there's light at the end of the tunnel for you, even in some of the harder times, because we all have them. You know, life happens. We make mistakes. We disappoint ourselves at times, but it's all part of the journey. It's all part of the process, the seasoning that's required to be able to do this at a high level. So just stay gracious with yourself. Be patient. Keep showing up, right? Even when you don't feel like it, keep showing up for yourself. Back test, do what you got to do. And yeah, you know, the rest will work itself out in time, you guys. Okay. So again, appreciate the support. God bless each and every one of you. And I'll catch you beautiful people bright and early here on YouTube on Tuesday, Wednesday, and Thursday of this week. And those of you in my private group will be live privately for the rest of the days. Okay. So God bless and have a good rest of your weekend, you guys. Take care.